Question 1. Which of the following is a key advantage of forming a captive insurance company rather than purchasing commercial insurance for a business? A. A captive insurance company guarantees low premiums in every scenario. B. A captive allows businesses to retain the underwriting profit and manage risks in a more controlled environment. C. A captive eliminates the need for reinsurance agreements. D. A captive insurance company removes all regulatory oversight from the business. Answer: B. A captive allows businesses to retain the underwriting profit and manage risks in a more controlled environment. Explanation: Forming a captive insurance company offers the primary advantage of enabling businesses to retain the underwriting profits from the risks they manage, rather than paying them to commercial insurers. This allows businesses to have more control over their insurance costs, claim management, and risk mitigation strategies. Option A is incorrect because premiums for captives may not always be lower than commercial insurance, especially during the startup phase. Option C is incorrect because captives often utilize reinsurance to mitigate large risks. Option D is incorrect because captives are still subject to regulatory oversight by the state insurance commissioner and must comply with solvency, reporting, and other legal requirements. Question 2. Mr. Thompson is the manager of a newly formed captive insurance company in West Virginia. The company is in the early stages of its formation and has completed the required application process with the West Virginia Insurance Commissioner. What is the next step Mr. Thompson must take to ensure that the captive meets the regulatory requirements for financial solvency? A. Mr. Thompson must immediately submit the company's annual financial report to the state. B. Mr. Thompson must establish a minimum capital reserve as mandated by the West Virginia Captive Insurance Act. C. Mr. Thompson must seek approval for the captive's premium rates from the West Virginia Insurance Commissioner. D. Mr. Thompson should set up a third-party administrator for claims handling before taking any further steps. Answer: B. Mr. Thompson must establish a minimum capital reserve as mandated by the West Virginia Captive Insurance Act. Explanation: West Virginia requires captives to establish and maintain a minimum capital reserve to ensure their financial solvency. This is crucial because it guarantees that the captive can meet its obligations and cover potential claims. The West Virginia Captive Insurance Act outlines specific capitalization requirements based on the type and risk profile of the captive. Option A is incorrect because financial reporting is required after a year of operations, not immediately after formation. Option C is incorrect because setting premium rates is part of the operational process, but it does not directly relate to meeting solvency requirements. Option D is incorrect because while third-party administrators may be used, the priority is ensuring the company meets capitalization and solvency requirements first. Question 3. Which of the following describes the role of reinsurance in captive insurance? A. Reinsurance in captive insurance is used to completely eliminate all financial risk from the business. B. Reinsurance helps captives manage large catastrophic losses by transferring portions of the risk to other insurers. C. Reinsurance is unnecessary for captives as they retain all risk internally. D. Reinsurance is used only to reduce premiums for policyholders within the captive. Answer: B. Reinsurance helps captives manage large catastrophic losses by transferring portions of the risk to other insurers. Explanation: Reinsurance is a common practice in captive insurance where a captive company transfers a portion of its risk to a third-party insurer to mitigate exposure to large losses, especially catastrophic events. This allows captives to maintain solvency and protect against unusually high claims. Reinsurance can also help captives manage their capital requirements and protect against volatility in claims. Option A is incorrect because reinsurance does not completely eliminate risk. It only helps manage it by sharing risk with another insurer. Option C is incorrect because, while captives may retain the majority of risks, they often use reinsurance to protect against large-scale or unexpected events. Option D is incorrect because reinsurance is a risk management tool, not a direct strategy to reduce premiums for captive policyholders. Question 4. Which of the following is the primary regulatory responsibility of the West Virginia Insurance Commissioner regarding captive insurance companies? A. To approve the formation of a captive insurance company only if it offers commercial insurance products. B. To oversee the solvency of captives, ensuring that they maintain adequate reserves to meet future claims. C. To manage the claims administration process for all captives operating in the state. D. To handle the day-to-day operations and management of captive insurance companies. Answer: B. To oversee the solvency of captives, ensuring that they maintain adequate reserves to meet future claims. Explanation: The The primary responsibility of the West Virginia Insurance Commissioner is to ensure that captive insurance companies remain solvent, which includes ensuring that captives have sufficient reserves and capital to cover their liabilities and claims. This is in accordance with the West Virginia Captive Insurance Act. Option A is incorrect because the Insurance Commissioner does not approve captives based on the types of products they offer, but rather on their ability to meet financial requirements. Option C is incorrect because the Commissioner does not manage claims administration, which is the responsibility of the captive management and claims teams. Option D is incorrect because the daily operations of captives are handled by their internal management or third-party service providers, not the Insurance Commissioner. Question 5. A captive insurance company in West Virginia has experienced an unusually high number of claims over the last year. The company's solvency is being questioned due to the depletion of its reserve funds. What action should the captive take to rectify this issue? A. The captive should immediately dissolve and cease operations to avoid further losses. B. The captive should seek additional capital through new ownership or reinsurance to restore its reserve levels. C. The captive should stop paying out claims to retain the remaining reserves. D. The captive should increase its premiums for policyholders to cover the current shortfall without any other actions. Answer: B. The captive should seek additional capital through new ownership or reinsurance to restore its reserve levels. Explanation: if a captive solvency is threatened due to inadequate reserves, it must seek ways to restore its financial stability. This can include raising additional capital through new investments, equity injections, or using reinsurance to share risk with other parties. The company must adhere to solvency regulations to avoid regulatory intervention. Option A is incorrect because dissolving the captive would not resolve the solvency issue in the short term and could cause significant financial and legal complications. Option C is incorrect because stopping claims payments would not be legally viable, as the captive must meet its contractual obligations to policyholders. Option D is incorrect because increasing premiums may not be sufficient on its own and could impact the captive's competitive position and relationships with policyholders. Question 6. What is the primary reason why businesses form group captives rather than single-parent captives? A. Group captives allow businesses to pool resources and share the risks, reducing the overall cost of insurance. B. Group captives are easier to manage than single-parent captives because they require less regulatory compliance. C. Group captives offer a higher degree of control over claims management and underwriting. D. Group captives are exempt from state insurance regulations, providing greater flexibility. Answer: A. Group captives allow businesses to pool resources and share the risks, reducing the overall cost of insurance. Explanation: group captives are formed when multiple businesses join together to pool their resources and risks. This helps reduce the overall cost of insurance and allows smaller businesses to access the benefits of captive insurance, such as more favorable terms, reinsurance options, and the ability to retain underwriting profits. Option B is incorrect because group captives still face regulatory compliance requirements and managing them can be complex due to the number of participants. Option C is incorrect because while group captives do provide some control, it is typically less direct than that of a single-parent captive. Option D is incorrect because group captives are still subject to state insurance regulations, including solvency and reporting requirements. Question 7. Mr. Wilson is the owner of a manufacturing company that has formed a captive insurance company in West Virginia. He's concerned about the company's ability to meet its long-term solvency requirements. What is one of the most important steps Mr. Wilson should take to ensure the long-term viability of the captive? A. Mr. Wilson should focus solely on reducing premium rates to attract more policyholders. B. Mr. Wilson should develop a comprehensive risk management strategy, including loss control measures and appropriate capital reserves. C. Mr. Wilson should reduce the level of reinsurance to maximize retained risk. D. Mr. Wilson should abandon the captive and purchase traditional commercial insurance to cover risks. Answer: B. Mr. Wilson should develop a comprehensive risk management strategy, including loss control measures and appropriate capital reserves. Explanation: to ensure the long-term solvency of a captive insurance company, it is critical to have a strong risk management framework. This includes not only setting appropriate capital reserves, but also implementing effective loss control measures to prevent large claims. The key to a captive's long-term success is managing risks effectively and maintaining sufficient capital to meet obligations. Option A is incorrect because focusing solely on reducing premiums can negatively affect the solvency of the captive by reducing the capital available to cover risks. Option C is incorrect because reducing reinsurance can increase the captive's exposure to large, catastrophic losses. Option D is incorrect because abandoning the captive and purchasing traditional insurance does not address the core issues and would result in losing the control and benefits that come with operating a captive. Question 8. Which of the following best describes the role of actuarial evaluation in the formation and ongoing management of a captive insurance company? A. Actuarial evaluations are primarily used to set policyholder premiums based on expected claim costs and risk factors. B. Actuarial evaluations are required only at the time of the captive's formation, and no further evaluations are necessary. C. Actuarial evaluations are used to determine the investment strategies of the captive reserve funds. D. Actuarial evaluations are optional and only used when the captive experiences unusually high claims. Answer: A. Actuarial evaluations are primarily used to set policyholder premiums based on expected claim costs and risk factors. Explanation: Actuarial evaluations are essential for determining the appropriate premiums for captive policyholders based on an assessment of expected claims, risk factors, and the company's financial stability. Actuaries use statistical models to predict future claims and ensure that the captive's reserves are adequate to cover them. This is crucial for maintaining solvency. Option B is incorrect because actuarial evaluations are necessary on an ongoing basis, not just during the formation of the captive. Option C is incorrect because while actuarial evaluations help with assessing risk, investment strategies are typically managed separately by the captive's financial team. Option D is incorrect because actuarial evaluations are essential for the initial and ongoing management of captives, not just in times of high claims. Question 9. Which of the following best defines a risk retention group RRD, and how does it differ from a traditional captive insurance company? A. An RRG is a captive insurance company that covers the risks of its members, typically for liability insurance, and is governed by federal laws rather than state laws. B. An RRG is a group of insurance companies that form a single insurer, pool in their resources to offer commercial insurance policies. C. An RRG is a type of captive that insures the risks of a specific industry, but it is not subject to any regulatory oversight. D. An RRG is a traditional insurance company that only covers non-liability risks for its members. Answer: A. An RRG is a captive insurance company that covers the risks of its members, typically for liability insurance, and is governed by federal laws rather than state laws. Explanation: a risk retention group (RRG) is a special type of captive insurance company that insures the risks of its members, who typically belong to the same industry or profession. Unlike traditional captives, RRGs are primarily governed by the Federal Liability Risk Retention Act rather than individual state laws. RRGs are primarily focused on liability coverage. Option B is incorrect because an RRG does not form by pooling resources from multiple insurance companies, but rather from businesses that share common risks. Option C is incorrect because an RRG is subject to regulatory oversight, albeit under federal rather than state regulations. Option D is incorrect because RRGs primarily provide liability coverage, not coverage for non-liability risks. Question 10. In West Virginia, a captive insurance company must submit which of the following to the insurance commissioner in order to demonstrate its financial solvency? A. Annual audited financial statements, including an actuarial report and loss reserve analysis. B. Quarterly reports showing only premiums collected and claims paid. C. Monthly balance sheets and profit and loss statements. D. A comprehensive insurance policy document for each line of business written by the captive. Answer: A. Annual audited financial statements, including an actuarial report and loss reserve analysis. Explanation: to demonstrate financial solvency, West Virginia requires captive insurance companies to submit annual audited financial statements, along with an actuarial report and loss reserve analysis. This ensures that the captive has adequate reserves to cover future claims and is financially stable. Option B is incorrect because quarterly reports are insufficient for demonstrating long-term solvency. Option C is incorrect because monthly reports are generally not sufficient to meet the full requirements of solvency demonstration. Option D is incorrect because policy documents alone do not provide an adequate picture of a captive's financial health. Question 11. What is the primary purpose of reinsurance for a captive insurance company? A. Reinsurance is used to transfer some of the captive risks to another insurer, reducing the financial exposure of the captive. B. Reinsurance is a strategy to increase the premium income of the captive by selling excess coverage. C. Reinsurance allows the captive to avoid paying claims to its policyholders. D. Reinsurance is used by captives to buy commercial insurance for risks that the captive cannot cover. Answer: A. Reinsurance is used to transfer some of the captive's risks to another insurer, reducing the financial exposure of the captive. Explanation: Reinsurance is a key tool for captives to manage risk. By transferring a portion of the risks to another insurer, captives can reduce their financial exposure, especially in the case of large or catastrophic claims. This helps captives maintain solvency and continue operations even in difficult circumstances. Option B is incorrect because reinsurance does not generate income but rather helps manage risk. Option C is incorrect because reinsurance does not allow captives to avoid claims. It merely helps manage the financial impact of those claims. Option D is incorrect because reinsurance is typically used by captives to manage internal risks, not to purchase commercial insurance for other types of coverage. Question 12. Which of the following is an example of fronting in the context of captive insurance? A. A captive insurer issues a policy but cedes the risk to a third-party insurance company, which then assumes responsibility for paying claims. B. A captive insurer sets aside a reserve fund to cover its liabilities. C. A captive insurer invests its premium income in stocks to generate additional revenue. D. A captive insurer increases premiums to reflect the current state of the insurance market. Answer: A. A captive insurer issues a policy but cedes the risk to a third-party insurance company, which then assumes responsibility for paying claims. Explanation: Fronting occurs when a captive insurance company issues policies but cedes the associated risks to a third-party insurer. This practice is often used when a captive wants to provide insurance for risks that exceed its own capacity but must appear to offer full coverage for regulatory or contractual purposes. Option B is incorrect because this describes a standard risk management practice, not fronting. Option C is incorrect because this describes investment activities, which are separate from the concept of fronting. Option D is incorrect because premium adjustments reflect market conditions, not fronting practices. Question 13. Which of the following is a typical benefit of using a captive insurance company for businesses in West Virginia? A. The ability to pool resources and reduce insurance costs by sharing risk with other businesses. B. The ability to reduce or eliminate regulatory compliance requirements compared to traditional insurers. C. The opportunity to control the underwriting process and tailor insurance coverage to specific business needs. D. The ability to automatically obtain commercial reinsurance without additional costs. Answer: C. The opportunity to control the underwriting process and tailor insurance coverage to specific business needs. Explanation: One of the key benefits of forming a captive insurance company is the ability to have greater control over the underwriting process and to customize coverage to the specific risks of the parent company. This can lead to cost savings and more flexible insurance options. Option A is incorrect because while some captives may participate in group captives, many are single-parent captives that do not share risk with other businesses. Option B is incorrect because captives are still subject to regulatory oversight, although they may face different regulatory requirements than traditional insurers. Option D is incorrect because while captives may purchase reinsurance, they are not guaranteed to obtain it automatically without costs or negotiation. Question 14. What does the term solvency margin refer to in the context of captive insurance companies? A. The amount by which a captive's assets exceed its liabilities, indicating financial stability. B. The amount of premium income generated by the captive over a year. C. The surplus of claims paid over the total premiums collected by the captive. D. The amount of reinsurance coverage obtained to mitigate catastrophic losses. Answer: A. The amount by which a captive's assets exceed its liabilities, indicating financial stability. Explanation: A solvency margin is the buffer or surplus that a captive insurance company has between its assets and its liabilities. It is a key indicator of financial stability, ensuring that the company has enough resources to pay future claims and meet regulatory requirements. Option B is incorrect because premium income is not the same as the solvency margin. Option C is incorrect because the solvency margin is about assets exceeding liabilities, not the relationship between premiums and claims paid. Option D is incorrect because reinsurance is a risk management tool, not a measure of financial stability like the solvency margin. Question 15. Which of the following is an example of self-insurance for a business, and how does it differ from a captive insurance company? A. A business sets aside funds to cover potential losses but does not establish a formal insurance company. B. The business establishes a separate legal entity to issue policies and accept premiums from its parent company. C. A business purchases a large deductible policy from a commercial insurer to cover major losses. D. A business pools its resources with other companies to create an insurance cooperative. Answer: A. A business sets aside funds to cover potential losses but does not establish a formal insurance company. Explanation: self-insurance involves a business setting aside funds to cover potential losses, typically in a reserve fund, without creating a formal insurance company. While similar to a captive in that both involve retaining risk, self-insurance does not involve the formation of a separate legal entity. Option B describes the formation of a captive insurance company, not self-insurance. Option C refers to purchasing a commercial insurance policy, not self-insurance. Option D describes a cooperative insurance model, not self-insurance. Question 16. A West Virginia-based business is considering forming a captive insurance company. Which of the following would be the primary reason for the business to choose a captive over purchasing traditional commercial insurance? A. To have greater control over premiums, claims management, and underwriting practices. B. To avoid paying any premiums to third-party insurers. C. To reduce the business's regulatory compliance obligations. D. To ensure that all claims are paid by the government rather than the business. Answer: A. To have greater control over premiums, claims management, and underwriting practices. Explanation: the primary reason businesses form captives is to gain more control over their insurance processes, including premiums, claims management, and underwriting. Captives allow businesses to tailor insurance coverage to their unique needs and potentially reduce overall insurance costs over time. Option B is incorrect because captives still pay premiums to cover their risks, but they do so within the structure of their own insurance company. Option C is incorrect because captives still face regulatory compliance requirements, although these may differ from traditional commercial insurers. Option D is incorrect because captives are not government funded and do not shift responsibility for claims to the government. Question 17. A West Virginia captive insurance company is concerned about large unexpected claims that could threaten its solvency. What is one potential solution to mitigate this risk? A. The captive can obtain reinsurance from a third-party insurer to cover the risk of large claims. B. The captive can cancel all insurance policies and stop writing new business. C. The captive can reduce its premiums for policyholders to increase cash flow. D. The captive can use its funds to invest in higher-risk ventures to generate higher returns. Answer: A. The captive can obtain reinsurance from a third-party insurer to cover the risk of large claims. Explanation: reinsurance is a common solution for managing the risk of large claims. By transferring some of the risk to a third-party insurer, the captive can protect itself from catastrophic losses that could impact its solvency. Option B is incorrect because cancelling policies would breach contractual obligations and is not a viable risk management strategy. Option C is incorrect because reducing premiums may worsen the solvency issue by reducing the amount of capital available to cover claims. Option D is incorrect because using captive funds to invest in high-risk ventures could create additional financial uncertainty and jeopardize the financial stability of the captive. Instead, the captive should focus on risk management techniques that help mitigate the potential for large, unexpected claims without introducing unnecessary investment risks. Question 18. In West Virginia, a business is considering forming a captive insurance company and needs to comply with regulatory requirements. Which of the following would be a key consideration for the business when selecting a domiciled state for the captive? A. The state's level of taxation on captive insurance premiums. B. The availability of reinsurance providers within the state. C. The reputation and track record of the state's insurance regulatory environment. D. The cost of incorporating the captive insurance company in the state. Answer: C. The reputation and track record of the state's insurance regulatory environment. Explanation: the regulatory environment is a key consideration for businesses when selecting a domicile for a captive insurance company. States with a strong track record of effective regulation and favorable laws for captives provide businesses with stability and assurance that their operations will be well governed. Option A is incorrect because while taxes are important, they are not as crucial as regulatory stability when choosing a domicile. Option B is incorrect because the availability of reinsurance providers is important but secondary to the regulatory environment. Option D is incorrect because the cost of incorporation, while a factor, is typically outweighed by the benefits of a favorable regulatory framework. Question 19. What is a pure captive insurance company? A captive that is formed to insure the risks of its parent company exclusively. B. A captive that provides insurance coverage to multiple unrelated businesses. C. A captive that exclusively handles personal lines of insurance. D. A captive that only offers reinsurance to other insurance companies. Answer A. A captive that is formed to insure the risks of its parent company exclusively. Explanation: a pure captive is an insurance company that is created solely to insure the risks of its parent company. It does not provide coverage to other businesses. This structure allows the parent company to retain risk and potentially lower insurance costs. Option B describes a group captive, not a pure captive. Option C is incorrect because a pure captive can provide both personal and commercial coverage depending on the parent's needs. Option D describes a reinsurance company, which is not the same as a pure captive. Question 20. What is the primary reason businesses in West Virginia might consider forming a group captive insurance company? A. To gain access to insurance markets that are otherwise unavailable to individual businesses. B. To reduce taxes by sharing risk with unrelated businesses. C. To invest funds collectively and pool resources for larger insurance portfolios. D. To gain access to government-funded insurance pools that cover catastrophic events. Answer A. To gain access to insurance markets that are otherwise unavailable to individual businesses. Explanation: a group captive is formed by multiple businesses that share the cost of coverage and pool their resources. The primary advantage of a group captive is the ability to access insurance markets that may be unavailable or prohibitively expensive for smaller individual businesses. Option B is incorrect because the primary purpose is not tax reduction but rather access to coverage. Option C is incorrect because while pooling resources is a benefit, the key advantage is accessing the insurance market. Option D is incorrect because group captives do not typically rely on government insurance programs. Question 21. What is the role of an actuary in the context of a West Virginia-based captive insurance company? A. To evaluate the company's investment portfolio and recommend financial strategies. B. To assess the risks and determine appropriate reserves for future claims. C. To ensure that the captive complies with state regulatory requirements. D. To manage the captive's day-to-day operations and claims processing. Answer B. To assess the risks and determine appropriate reserves for future claims. Explanation: an actuary plays a key role in analyzing risks and determining the reserves that a captive must hold to cover future claims. They use mathematical models and historical data to predict potential future losses, helping the captive maintain solvency. Option A is incorrect because investment strategy is typically handled by the financial management team, not the actuary. Option C is incorrect because regulatory compliance is typically managed by the captive's legal or compliance team. Option D is incorrect because claims management and day-to-day operations are usually handled by an operations team, not the actuary. Question 22. In West Virginia, which of the following is a common advantage for businesses that form captive insurance companies? A. The ability to avoid all claims made against the business. B. The ability to retain and invest premium income for the benefit of the parent company. C. The ability to operate without any regulatory oversight. D. The ability to automatically reduce premiums for all types of insurance coverage. Answer B. The ability to retain and invest premium income for the benefit of the parent company. Explanation: one of the key advantages of forming a captive insurance company is the ability for the parent company to retain and invest the premium income, which can lead to financial benefits and more control over risk management. Option A is incorrect because businesses are still responsible for claims made against them, though captives can help manage this risk. Option C is incorrect because captives are subject to regulatory oversight, even if it's less stringent than that for traditional insurers. Option D is incorrect because while captives may lower premiums for certain types of coverage, this is not automatic for all types of insurance. Question 23. Which of the following best describes captivity management for a West Virginia-based captive insurance company? A. The process of overseeing the operations, financial management, and regulatory compliance of the captive. B. The act of marketing the captive's insurance products to external clients. C. The process of managing claims filed by external policyholders. D. The process of coordinating reinsurance contracts and pricing with third-party insurers. Answer: A. The process of overseeing the operations, financial management, and regulatory compliance of the captive. Explanation: Captivity management involves the oversight of all aspects of a captive insurance company, including its financial health, regulatory compliance, and operational efficiency. This can be managed internally or outsourced to specialized firms. Option B is incorrect because captives typically insure the risks of their parent company, not external clients. Option C is incorrect because claims management is part of the broader operations but not the full scope of captivity management. Option D is a part of captivity management, but it is not the defining characteristic. Question 24. A West Virginia business is forming a captive insurance company to cover employee health risks. What should the business consider when determining the premium amounts for the captive? A. The amount of risk the business is willing to retain and the expected claims experience. B. The total assets of the parent company and its financial stability. C. The market price of commercial health insurance policies available in the state. D. The number of employees covered by the health plan. Answer: A. The amount of risk the business is willing to retain and the expected claims experience. Explanation: When determining premium amounts for a captive, the business must consider how much risk it is willing to retain as well as its projected claims experience. This involves analyzing historical claims data and risk levels to ensure that the premiums are sufficient to cover future liabilities. Option B is incorrect because while financial stability is important, it does not directly affect premium calculation. Option C is incorrect because commercial market prices are less relevant for captives that customize their coverage based on internal needs. Option D is incorrect because the number of employees is one factor but does not fully determine premiums. Question 25. Which of the following is a key factor when determining the solvency of a captive insurance company in West Virginia? A. The number of policyholders covered by the captive. B. The ability of the captive to pay its claims and meet its financial obligations. C. The premium rates charged to policyholders. D. The geographical location of the captive's operations. Answer: B. The ability of the captive to pay its claims and meet its financial obligations. Explanation: Solvency refers to the ability of an insurance company, including captives, to meet its financial obligations, especially when it comes to paying claims. This is assessed through financial strength, reserve adequacy, and liquidity. Option A is incorrect because the number of policyholders does not directly determine solvency. Option C is incorrect because premium rates alone do not guarantee solvency. Option D is incorrect because geographical location is not a direct factor in solvency assessments. Question 26. In the context of West Virginia captive insurance, what is self-insurance? A. A company that forms a captive to manage its own risks. B. A company that buys traditional insurance policies from an external insurer. C. A company that does not purchase any insurance but sets aside funds for potential claims. D. A company that buys reinsurance to protect its own policyholders. Answer: C. A company that does not purchase any insurance but sets aside funds for potential claims. Explanation: Self-insurance occurs when a company chooses to retain its own risks rather than transferring them to an insurance provider. It sets aside reserves to cover potential claims. This is different from captive insurance, which involves forming a company to manage risk in-house. Option A is incorrect because forming a captive is a structured approach to managing risk, not self-insurance. Option B is incorrect because purchasing traditional insurance is not self-insurance. Option D is incorrect because reinsurance protects the insurer, not the company's own risks. Question 27. What is the primary reason a business in West Virginia might choose to use a rent-a-captive? A. To avoid regulatory scrutiny by operating outside the state. B. To lower insurance premiums by pooling resources with other businesses. C. To create its own captive insurance company without having to establish a fully separate entity. D. To gain access to government-funded insurance for catastrophic risks. Answer: C. To create its own captive insurance company without having to establish a fully separate entity. Explanation: A rent-a-captive allows businesses to access the benefits of a captive insurance structure without the need to form a separate, fully owned company. The business rents space within an existing captive insurance structure managed by a third-party provider. Option A is incorrect because rent-a-captives still comply with regulatory requirements. Option B is incorrect because pooling resources is not the primary reason for using a captive. Option D is incorrect because rent-a-captives are not designed to access government insurance programs. Question 20. In West Virginia, what is the role of a fronting company captive insurance arrangement? A. It provides investment funds to the captive to help cover potential losses. B. It assumes the direct underwriting responsibility for the captive's risks. C. It acts as a reinsurance provider for the captive. D. It serves as the legal owner of the captive's policies. Answer B. It assumes the direct underwriting responsibility for the captive's risks. Explanation. A fronting company is a licensed insurer that issues policies on behalf of a captive, typically because the captive itself does not have the necessary regulatory approval to write certain types of business directly. The fronting company assumes the direct underwriting responsibility but may then reinsure the risk back to the captive. Option A is incorrect because a fronting company does not provide investment funds. Option C is incorrect because the fronting company is not a reinsurance provider, but rather an insurer. Option D is incorrect because the fronting company does not own the captive's policies, it merely underwrites them on behalf of the captive. Question 29. Which of the following is typically the primary reason a business in West Virginia would create a risk retention group to pool risks with other businesses and reduce premium costs? B. To guarantee coverage for its employees through a captive insurance policy. C. To offer commercial insurance policies to external clients. D. To share its risks with a government-sponsored insurer. Answer A. To pool risks with other businesses and reduce premium costs. Explanation. A risk retention group, or RG, is a type of captive insurance company formed by businesses with similar risks to pool their risks together. By sharing the costs of risk, the group can reduce premium costs for all members. Option B is incorrect because our IGS are typically formed for business risks, not to insure employees specifically. Option C is incorrect because an RRG does not generally offer insurance to external clients. Option D is incorrect because RRGs do not rely on government-sponsored insurance. Question 30. Which of the following is a benefit for a business in West Virginia forming a captive insurance company? A. Immediate access to a global reinsurance network without underwriting approval. B. Increased control over the business's insurance coverage and risk management strategy. C. Guaranteed reduction in the cost of claims over time. D. Automatic coverage for all types of business risks, regardless of scope or size. Answer B. Increased control over the business's insurance coverage and risk management strategy. Explanation. One of the main benefits of forming a captive insurance company is that it gives the business increased control over its insurance coverage and risk management strategies. The company can tailor policies to its specific needs and better manage its risks. Option A is incorrect because forming a captive does not automatically grant access to a global reinsurance network. Option C is incorrect because while captives may help reduce costs, there is no guarantee of lower claims costs. Option D is incorrect because captives can provide coverage for specific risks, but they do not automatically cover all potential business risks.